I've never had an investor get mad at me when I gave them more money than they were expecting. Always underpromise what you think you can do based on your realistic underwriting and present the underpromise and then overdeliver in execution. So the way we generally structure our deals is pretty cookie cutter now. Of course, there's going to be some amount of input from your lender. They're going to want to have like a bankruptcy remote entity or a TIC structure or whatever. But generally speaking, the way we structure is we have our title holding entity at the top. Then we have our investor entity below, and the investor entity owns 100% of the title holding entity. And then in the investor entity, we have different buckets. So we have anywhere between 2 to 7 different share classes that our investors can invest into. And we just name them like A, B, C, D, E, F, G, whatever. And then we have a share class that's a manager share class. Now that share class is another entity, which is our GP entity. And that is owned by any of the general partners in the deal. On the deals that we've done, like the last $500 million of deals we've done, it's been myself and our JV partner, so Vive Funds and our JV partner own the GP entity together. We co-own it together. And then that might change or have variations depending on if there's like a 1031 exchange, what the lender requires. If there's pref equity in the deal, it'll have some variations, but that's the general framework. So if you think about it like 123 Main Street title holding entity, 123 Main Street LP entity where your investors invest into. And as part of that, you have 123 Main Street GP entity or manager entity, and that manages the investor entity, and the investor entity manages the title holding entity. So that's a general structure how we do our deals. The best way to project what the metrics of your return expectations for your investors is really going to be through a couple of different things. One, it's really knowing and understanding the input. If you put garbage in, you're going to get garbage out. So you want to make sure you have really good data because that's going to be a realistic expectation of what investors are going to see. And you shouldn't be too far off, barring something crazy like COVID happening or interest rates spiking overnight. You should generally be in the ballpark. Then what we do is we stress test. So we start saying like, okay, if we pull this lever, what happens to the return? If we pull that lever, what happens? If we pull both of these, what happens? How do we mitigate risk here? How do we prevent this from happening? We don't always have the answers, but we do know if occupancy drops below a certain level, we know investor returns are going to start suffering. We know if we miss a pref payment that the IRR is probably going to drop. So we can stress test the sensitivity around those and kind of see what that world of investment looks like. The other thing that we do is if we see our underwriting showing a 15% IRR net to investors, we'll usually arbitrarily drop that by a little bit. So we might advertise or market it as a 14% IRR because you always want to underpromise and overdeliver them more money than they were expecting. So the moral of that story is you should always underpromise what you think you can do based on your realistic underwriting and present the underpromise and then overdeliver in execution. So our pro forma numbers, it's an underwriting template or model. There's like a million of them out there. We've actually developed our own in-house that is proprietary to us, but a lot of people get hung up in the model and they're like, oh, I'm going to get my hands on Veena's model because they think it's like something that is totally unique, and it's not. It's just how we look at deals. So that's why it's proprietary to us. Your model is probably going to be similar to underwrite and put the metrics in. We do a lot of different things. Like I said, we pay for national databases of millions of data points so we can make good predictions, but we also walk the asset. So we'll go physically walk the asset to make sure the numbers, the story we're hearing, and what we see are all in alignment with each other. We also will secret shop our competitors. So we'll go to the nearest, call it 5 assets in the area, and we will secret shop them, we'll comp shop them, we'll try to find out what are they charging for pet fees? Do they have an application fee? How many units do they have available? Are there new apartments coming online, right? We look at that as a kind of a holistic picture, and then we enter it into our model and it'll spit out numbers back to us. So our metrics for calculating investor returns, I guess without a spreadsheet, the most basic way to say it is we take the NOI, or the net operating income. So we take total income minus total expenses. That gives us our NOI, which is our net operating income. We then subtract our anticipated debt service, and whatever is left is our free cash flow. That free cash flow, just from our strategic perspective, we always try to distribute to investors as much as possible, as quickly as possible. And so we will take whatever free cash flow we have, and assuming that there's enough, we'll take our asset management fee and then we'll distribute to investors in accordance with our PPM, our waterfall model. If there's anything above and beyond that, then we distribute according to whatever the next hurdle is on the waterfall. But whenever we project to investors, or we send an OM out or a PPM out, all of our return metrics that we say to investors are always net of any fees or costs. So let's say I anticipate a $10,000 free cash flow in a month, and I know that we're going to charge a $1,000 asset management fee. I'm making this up. That $1,000 asset management fee. Then we project that they're going to get $9,000 returned to them, not $10,000, if that makes sense. So a preferred return is basically a variation on a profit split. It is a profit split. So what a preferred return means is, so let's say I'm giving you a 6% preferred return with a 70-30 split to a 12% IRR and then a 50-50 split. What that means, a 6% preferred return means if you invest $100,000 with me, I am going to give you every dollar of cash flow until you get to a $6,000 return that year. Let's say I have an extra $10,000 after I've paid you the $6,000. Then we go to our 70-30 split. So that's the next hurdle in the waterfall. That means that you as the investor are going to take $7,000 and I'm going to take $3,000. That's my promote, or my carried interest as the sponsor of the deal. Once I deliver you a 12% IRR on your $100,000 investment, then we have what I like to call our home run hurdle. That means we've delivered a home run, we've gone above and beyond the 12%, and then that we split 50-50. And the idea behind that, or the way we put our investors into alignment with us, is that we say, look, if we deliver above and beyond, then we make more. And most investors are good with that because we're just splitting a larger pie now. So they still make more money. And look, you as an LP, you want your general partner this invested in your deal. You want them to make more money the better they perform. Otherwise, you're at risk for them turning their attention to this other asset over here, which might make them more money. And so you want to be in alignment with your investors from top to bottom. And so having a preferred return really insulates investors from the downside, but allows them to participate in the upside. So that's why we structure our deals like that. You certainly don't have to. There are many investors that structure with a straight split, or they have like a clawback or a catch-up. So there's a lot of different ways to structure it. This is just how we do it because we found it speaks to our investors the best. They feel the most comfortable with it. It works for us and everybody's happy. So it's a win-win. As a general rule, we always reduce or defer our fees to investors if we're missing our pro forma expectations, because we, again, want to treat the investor as, the gold standard, and how we treat them is how I would want to be treated, right? I don't necessarily want you to take an asset management fee if you're capital calling me simultaneously. This is actually a question I got a lot in the capital call was, are you still taking fees? And I'm like, no, we stopped taking fees 18 months ago when we first had signed them any trouble on this asset. And investors were really surprised by that. So that also taught me that we should communicate that we're doing this. They thought we were still getting paid while we're simultaneously capital calling them. And that just isn't the case. And so that's how we personally look at it. Is it the only way? No. Is it wrong to take fees? No, because you have to keep the lights on. That's the hardest thing, is can you keep the lights on? Because investors still want you working. They still want you to be able to run the world of investments. that they have their money invested with you in. And so it's not wrong. It's just our philosophy has always been to either defer or waive the fees. It doesn't make sense for you to waive or defer fees if that is the lifeblood of you keeping the lights on in the company. So if you cannot pay your payroll, if you cannot pay for your office rent, if you cannot keep your internet or your systems or processes up and running because you don't have those fees, then it may make sense to continue taking those fees, even if it feels out of alignment. But if you're going to do that, I strongly, strongly recommend that you reach out to investors and clearly communicate what you're doing and why. And usually your PPM should allow you the latitude to be able to do this. So just communicate, communicate, communicate.